historically is extremely volatile. I think that the underlying trend in gold is up because I believe that the underlying trend in the purchasing power of the US dollar is down. But we've come very far very fast. People who can't tolerate volatility need to consider taking some profits. I have no problem with volatility. I love volatility. I've been a beneficiary of it and a victim of it for 50 years, so it comes with the territory. If you ask me where we are in the gold bull market, really, I think we're very early on. I liken this to the decade of the 1970s. I believe it's likely that the US dollar loses ultimately 50 to 75% of its purchasing power in the next 10 years. Not relative to other currencies, but absolutely. The consequence of that is that I think gold trades higher. The shot that we've seen very recently, I think, is an advanced market indicator of the fact that investors and savers worldwide are very concerned about the impact of an interest rate reduction in the US. A widely telegraphed trade and gold moved anyway. As the market digests that news, it wouldn't surprise me at all, given the near-term overcrowded nature of the short dollar trade, to see gold sideways to down. But if you have a 2-year time frame, a 5-year time frame, or a 10-year time frame, I think gold goes much higher. Traditionally, gold bull markets follow a very predictable pattern. The metal moves first, and that was certainly the case this time. In prior interviews, I remember that some of your viewers were expressing frustration. 2022 is an example. The gold price was moving, but the gold stocks weren't. There was then a simple explanation. Foreign central banks were buying gold, and they don't buy gold stocks. So a market that had a bid went up, and a market that didn't went down. But there's a second reason that's much more traditional. It takes a while for an increase in the gold price to translate into an increase in gold producers' operating margins. We began to see that in 2024, and we saw it expressed in the market in 2025. In a typical gold bull market, it goes like this. Gold to the best of the best, the Francos, the Wheatons, the Agnicos, to the best of the rest, the Newmonts, the Barricks, the Kinrosses, to the junior producer, the single asset producer, the developer, the explorer. What's changed this time is that the whole process of the money moving down market has accelerated. What happened in the prior bull markets in my lifetime is that the best of the best moved first, and they attracted market multiples, market capitalizations that were excessive relative to the rest of the sector. And so valuation arbitrage would take place. Guys like me who said, Newmont is cheap compared to Agnico would move down into Newmont or down into Kinross. Or if they didn't, the guys with lower cost of capital, which is to say higher share prices, would take over. What's been unique about this is that the whole process is accelerated. We have gone from the best of the best, the Francos, the Wheatons, the Agnicos, all the way down even to the advanced explorers. And we've seen that happen in 18 months. That cycle through the rest of my career has taken 4 years, and it's interesting, and I don't really know why it's happened. Perhaps it happened because that sector was so ludicrously oversold. Perhaps it happened because life of cycle bottoms in 2021 and 2022 were farcically low, and what we've seen in the juniors is a dead cat bounce. I'm not sure what we've seen, but what I have seen is that the best of the juniors have all taken advantage of these higher prices to come to market to raise capital. And for the best of the juniors, all of these capital raises have been substantially oversubscribed, which tells me that the money is present in this bull market, and the gold bull market is really, truly underway. It also tells me that investors need to be more careful. If the price of a company doubles without any change in the fundamental news around the company, it is, of course, half as attractive as it was before the price doubled. And so people need to pay attention to that. They are no longer in the easy money part of the cycle. The easy money part of the cycle is when companies go from being hated to being tolerated. And gold is certainly no longer a hated asset class. That's not necessarily inconsistent philosophically. Oil prices often move as a consequence of broad economic trends. A soft economy on a global basis often stimulates quantitative easing, which is a fancy way of saying counterfeiting. The government response to a soft economy is often printing phony currency, which is good for gold. It doesn't always happen, but you bring up an interesting point in that it's likely that speculators and investors with a strong constitution need to begin to allocating substantially more resources in the oil space, which is hated, or at least ignored. Investors who are more momentum oriented and traders definitely want to be in the gold space because now you're in the way of the money. And it's worthy to note that although the gold trade is attractive to you and I, given where we've been, most investors can't spell gold. It is not a crowded trade if the crowd that you're talking about is the generalist investor. The generalist investor, as is evidenced by money flows into gold-oriented and gold equities-oriented ETFs, is still very constrained. The gold equities ETFs are increasing in net asset value because the gold price is going up. In fact, they're experiencing a negative flow of funds. So this is a story that likely has legs, albeit it's a story that's going to be very volatile. The last statistic I have was from JP Morgan Chase. And JP Morgan Chase said that the global allocation to precious metals and precious metals equities in the US was only 0.5%. Put specifically, 0.5% of the total savings and investment assets in the United States are allocated to precious metals and precious metals equities. That's down from a 4-decade mean of 2%. So if the allocation merely reverted to mean, you would have a 4-fold increase in demand. I have no idea what a 20% market share, which would be a 40-fold increase in the allocation, would do. I don't think it will occur, to be honest with you. I don't think a 20% allocation, given what I see to be the certainty, the inevitability of a decline in US dollar purchasing power, combined with artificially low interest rates. I don't think in that circumstance that a 20% allocation is out of line. Think about the arithmetic of the competing instrument, which is certainly the US 10-year Treasury. If inflation continues at its current pace, and by the way, inflation should not be measured by the CPI. If inflation maintains its current pace, which I think is closer to 8%, and the interest on the US 10-year Treasury stays at 4.5%, what that means is that gold's competing instrument, the US 10-year Treasury, guarantees that you will lose the delta between inflation and the interest it pays, which is to say 3.5% a year for 10 years. In other words, in the US 10-year Treasury, you're guaranteed by the US government that you will lose between 35 and 40% of your purchasing power over 10 years. That's pretty constructive for gold. So that 20% number is a very interesting number. I don't think it has a hope in hell of occurring, but I wouldn't necessarily discourage it, particularly given what I consider to be the certainty of challenges around the US dollar maintaining its absolute purchasing power over the next 10 years, which I consider the probability of to be nil. We are interested in the delta between what companies are selling for, which is to say their enterprise value, and what they're worth, which is to say their net present value. We overlay a few variables. One, our opinion as to the direction of the underlying commodity price, which impacts net present value. Our impression of the management's specific skill sets around maximizing the return on capital employed, but also recycling the free cash flow from existing production into growth. And we attempt to measure various types of extraneous downsides, political risk, social risk, that type of thing. We are pretty uninterested in technical analysis. We are pretty uninterested in momentum. The real discipline that we follow is deposit quality, net present value, probabilities of growth, but most importantly, the discrepancy between price and current value and expected value of the deposit. Very much bottoms up, fundamentally oriented. We look particularly for deposits, whether producing or not, that will be in the lowest cost quartile in their commodity type worldwide. We also look for deposits that will be in the best quartile in terms of profitability measured by return on capital employed in their sector worldwide, but at least 25% return on capital employed. We are particularly attracted to companies that are in commodities that are out of favor, hated, which are often cheap. The easiest money to be made as a speculator is in a sector where it moves from unloved, read uranium 14 months ago, to tolerated, or even liked, read uranium today. So our rankings for out of favor commodities, nickel as an example, are higher than the streets. Our rankings for commodities that are decidedly in favor are often lower than the streets, because remember, we don't penalize for volatility, and we are interested in absolute discrepancies between expected net present value and price today. Actually, I should say we're doing 1 to 10 these days to add some nuance. To put it in perspective, I've had 11 one rankings, which is my top ranking, in 35 years of ranking stocks. A one means that I have to believe that the company is selling for half of current net present value. I have to also believe that net present value could reasonably easily grow tenfold in 5 years. I have to believe that there is a catalyst in place that will increase my expectation of net present value by 100% in 2 years or less. In other words, I'm expecting a 2-year double at current commodity prices, and I have a reasonable expectation of a tenfold increase in 5 years. But a tenfold increase in 5 years where the company is already selling at a 50% discount to current net present value. That's a pretty rare crowd. The consequence is I've had 10 or 11 of those in 35 years. A 10, by contrast, is a company where I would suggest that speculators, at least, establish substantial short positions, where I think that there is a probability that the company will be bankrupt within 2 years. Not salvageable. Mostly the very poor companies, the companies 7 or below on the scales, I don't bother to rank. There are something like 4,000 public oil and gas and mining companies worldwide. We follow about 800 of them. And the companies that are on the very poor end of the scale, we very seldom rank because there's no particular reason to follow them. We only follow them if they're heavily promoted and widely owned, so that we think within our audience that there is a reasonable reason for us to spend the time and treasure involved in generating a lousy ranking, a 7 or an 8. If you want to be in the silver space, and I think we're in the very early innings of a silver bull market, you need to consider Buenaventura, Peñoles, Fresnillo, the Latin American, Peruvian, or Mexican miners. But you face real social and political risks with these companies. Core mining I have as a 6. I think they're going to perform very well in the near term. And they've performed well as a consequence of an increase in free cash flow that came about from their acquisition of an existing producing mine, which is generating tons of cash, but has a fairly short mine life. If the management team isn't able to allocate the cash flow from the Silvercrest asset in an accretive fashion, you're going to have some ugly surprises there because it's trading on a high free cash flow multiple where the free cash flow has a short reserve life. So I'm concerned about Core. I don't own Core. Endeavor Mining I own. You have real political risk here. They have done an absolutely superb job of building the company over 25 years with frontier exploration and development in French West Africa. French West Africa is undergoing severe social and political change. It's also important to note that the team that built Endeavor Mining, the financial team, is now in South America building Aris Mining, which is to say the people who led the growth are gone. And the mine building team, at least one of 2 mine building teams, is now at Montage Gold. So whereas in normal circumstances on a valuation basis, I might even have Endeavor at a 3, the consequence of management turnover is that I have it at a 5. On a valuation basis, it is cheap.